Hi, everybody, and welcome to the Power of Credit. I hope you joined us last week while we talked about budgeting. Budgeting will really help with credit because especially if you're trying to uh, do some credit repair, it will help you allocate the types of funds that you might need for that. So we're going to just launch right into the Power of Credit. My name is Miria Gray. I am the Community Education Officer for Chelsea Groton Bank. And today we are talking about the power of credit. If I do not touch on anything, something that you were hoping to know about, please feel free to reach out to me. My contact information is at the end of this PowerPoint presentation. So we're going to cover what is credit, the credit reports, myths about credit, credit do's and don'ts, credit scores, and all right, so let's start out. True or false? Having access to credit is a consumer right. So since you can't answer, I'm going to go ahead and tell you it is false. Having access to credit is a privilege. You have to earn credit. So it's also a responsibility. So as we're talking about credit, we are talking about any borrowing that you might do, credit cards, auto loans, home loans, whatever, personal loans, boat loans, like all of those things. Your credit is your reputation as a borrower. So credit is the money that's extended to you, but it's also your reputation as a borrower. So the credit cycle is this. You get your credit, you use your credit, oops, sorry, you pay the lender updates their records, then they share their records with the credit reporting companies, then the credit reporting companies share with new lenders. So it's kind of a cycle, which can absolutely break down if you do not pay the lender, right? Because then everything that comes after that is not necessarily positive. So if you get the credit, you use the credit, and then you don't pay for the credit when they update their records, it's not good. When they report it to the credit reporting companies, it's not good. And when they share with other new lenders, it's not good. So you want to make sure that you are making sure to include that paying the lender piece. True or false? Credit reporting companies like Experian, TransUnion, and Equifax decide whether a credit application is approved or declined. So the answer to that is false. The companies decide. So credit reporting agencies are like libraries. So your other companies are just checking out credit histories if they have a permissible purpose. So all they're really doing is collecting the information. It's really up to the person or the business that is extending the credit to you. Chelsea could lend to somebody with a very low credit score if it were our policy to do that, right? Because we get to decide. It would probably be a bad decision on our part if the person has a history of not paying back loans that they've taken in the past. But we could do it. But it's our policy not to do that, right? Because if we're lending to people that don't have good credit, then we will not have the money to lend to people that do have good credit. So what's permissible? Like what would somebody have permission to look at your credit? To open or manage your credit account. So like all of those pre-approved offers that you get in the mail, you fill one out, you return it. Obviously, they're going to check your credit. If you already have credit, they could be managing and probably are making sure to watch your credit score to make sure that you are keeping up to date with your other obligations also. Offers of credit. So those pre-approved things, employment purposes. So many employers might check your credit. Underwrite insurance. So your auto insurance, your home insurance, and all those types of things, they are checking your credit. The actuaries that are determining whether you're going to be a risky driver are deciding whether you're a risky borrower. So they're looking at that. If you're risky in one area, then the actuaries are deciding you might be risky in other areas. So good credit really helps also your insurance to be lower. Eligibility for government license. So like different things like a CDL and things like that. Any kind of government licenses you have, security clearance that you might need, military, EB, maybe the police department. I know Chelsea does check credit. You definitely wouldn't want somebody with bad credit and a history of debt to be managing your money. So plenty of employers do check your credit. The next three are if you own a business. So after retirement, if you're considering going into business, these might apply to you, but right now they currently don't unless you own a business in addition. A business transaction, risk evaluation by an investor, and disclosure to a consumer. So business transaction, so like if you owned a hair salon and then you needed to buy product, um, most people would get that on credit, right? They would deliver the product to you and then you would pay for the product after the fact. That's credit, right? So they are checking personal credit for that because usually most startup businesses do not have business credit yet. Risk evaluation by an investor. So if like you're going to bring an investor into your company, they're going to want to know if you are personally in debt before they buy into your company. Disclosure to a consumer. So either checking your own credit or if you're going to be publicly traded, which most of the people watching this right now are probably not going to have a company that's going to be publicly traded on the stock market. So what is a credit report? Your credit report is your detailed report of your credit history. So the credit bureaus collect that information, and then based on that information, lenders use those reports to determine your credit worthiness, right? Here is kind of a sample one. There are three. They're all going to look different. This is just kind of a sample of what you're going to find on there. Your information about you, your personal identifiable information. This is the information that they're going to be asking questions about to verify it's you when you go in to have access to your credit report. Your name, current and previous addresses, social security number, date of birth, and other information that identifies you personally. They have access to like all of your past names. So if you've been married, adopted, change your last name for any reason, they have access to all of your previous addresses, previous phone numbers, kind of anything that maybe you would have either filed taxes with or you would have used in the past, maybe to get an apartment or a new phone number with the phone company or something like that. Section B is your public record information area. And so that's the information from your local, state, and federal courts, like a bankruptcy. Not all financial things are found on your credit report. What is found, bankruptcy and missed child support payments. Those will also appear there. There are some other things, but those are the two most common. C is collection agency account information. So if one of your accounts has gone into collection, meaning you haven't paid it and they have sent it to a collection agency, that will appear there. And section D is your credit history, kind of the things that you would anticipate being on there. It's a list of all of the credit that has been extended to you, who extended you the credit, when the account was opened, is it still active, the account number, the latest activity on that account, the amount of credit that has been extended to you, the amount of credit that you're using, and if you are past due or have ever been past due. In section E, the last section is inquiries. So every single time that somebody checks your credit, or inquires about your credit, you get an inquiry. The only thing that doesn't show up on there, would be like if you checked your own credit. All right, some recent or upcoming changes. Medical debt. So starting on July 1st of 2022, so now 2 years ago, paid medical collection debt, bills that were turned over to a collection agency, but eventually you paid them, will no longer appear on credit reports. So previously, if you paid it and then, whatever, it would still appear there for potentially the next 7 years, 7 to 10 years. So now, once you pay it, it's gone, but that's just for medical debt. Also, July 1st, consumers will get a full year to work out insurance and billing issues before it's reported to their credit. Before it was 6 months. And so, what used to happen is you would get a bill from a hospital, maybe several months after the whatever appointment that you had was, because they've sent things back and forth to your insurance company, something wasn't satisfied. So they send you the bill. Maybe it's already 4 months later. And then after 6 months, they could report it as delinquent. Now they have to give you a year to work out a payment plan for that. In the first half of 2023, the credit bureaus all were told that they needed to begin omitting any medical debt that was under $500. So if you owe $350 to Yale, then it should not appear on your credit report. Not that you don't owe it or that they won't send a collection agency after you, it just isn't going to appear on there. Buy now, pay later accounts. So if you've shopped anywhere online, I am sure that you have seen these. It's like Affirm and other things like that. You've been offered the opportunity potentially to like break that payment up over time by using this buy now, pay later. They provide people with some flexibility. I even saw it on Instacart, and like I'm wondering why I would want to spread my groceries out over 4 weeks when likely I, that's going to increase my grocery bill for the next 4 weeks. But things happen. Sometimes people are in an emergency. It's a handy thing to have. The thing to know is they are classified on your credit report as a short-term loan. That's most likely because there's nothing else to classify them as, really. And the credit reports haven't really caught up with technology yet. So I think probably over the next couple of years, we'll be seeing some more changes to the way that credit reporting happens based on technology and what is available to us for payment plans. Okay. New FICO versions. There are more than a dozen versions of FICO. The most recent version, which is the FICO 10, came out in January of 2020. Basically, nobody touched it for years because we were in the middle of COVID. And the amount of changes that happened with this version of FICO were enormous. It is important to note that many companies are starting to use this version of FICO, and it is very different and will affect people's credit scores. So this version looks at trended data. So it's looking at your 24 months instead of a snapshot of right now. So, 8 and 9 still remain the most widely used, but people using 10 are going to see their scores potentially rise or fall, and this is why. So previously, if you wanted to raise your credit score, all you had to do was go in and pay down your debt, because that would give you more points to your credit to debt ratio. It would improve your credit score, right? That will not work anymore, because if you have a long history of carrying high balances on your credit card, they're looking at the past 24 months, so 2 years, instead of the snapshot of what your balances are right now. Previously, they're just looking at the balances right now to get your credit score. The 10 looks at your balances over the last 24 months. So for some people, this is great, right? Because if you had to go out and get a refrigerator and you just didn't have the money, and so you put it on your Home Depot card, and that was something that you took care of in like 4 months, but it kind of messed up your credit score a little bit. It won't mess up your credit score anymore, because over the last 24 months, everything was good. Only 4 of those 24 months you were carrying a higher balance. Now, if you have been carrying a higher balance, like you bought that refrigerator, you're just paying the minimum balance every month, and for the past 24 months, 20 of the past 24 months, you've carried a really high balance on that Home Depot card, and then you paid it off because you wanted to go get a home loan, the 10 might show that you really do carry a high balance on that card a lot, and so your credit score could be lower. It shouldn't be a huge difference, maybe a swing of 20 points here or there, depending upon what your credit looks like. But it's just something to really be aware of. All right, so how do you check your credit report? You can go to annualcreditreport.com. That is the one that we recommend. Don't, like, I am probably, again, preaching to the choir here. Don't just stick it into Google, because if you put it into Google and call it a day and you click the top one, you might not get annualcreditreport.com. You might get some other annual credit report or credit reporting checking service that might not be as reputable. We only recommend annualcreditreport.com. You can also call the phone number. They are just going to ask you a whole bunch of questions. When they ask you the questions, know that you have called them, and so they have to verify that it is you. If they call you, again, probably preaching to the choir, but I am always saying it. If you call them, they're verifying it's you. If they call you, you are supposed to be verifying that it is them. So they will definitely be asking a lot of questions. They will also ask a lot of questions as you're logging in online. They do have to verify it is you in order to set up your account. So lots of personal questions. You can get all 3 companies, Experian, TransUnion, and Equifax. And the thing to know is that not all credit companies report to all credit reporting agencies. So your Experian report will look different than your TransUnion report, will look different than your Equifax report. They might not look the same, because maybe your mortgage reports to all 3, but your Visa card only reports to Experian. So you could be seeing different things. Okay. So if you don't agree with what you see on your credit report, you can initiate a dispute. So say you went in there, you see that you canceled your cell service with Verizon 6 months ago. They're still reporting that you owed money, but you know that you made your last payment. If you have proof of that, hopefully you do, you can initiate a dispute. I would initiate a dispute even if you don't have proof of it. So there's like a little button there to be able to dispute charges or things. So you're going to need to allow 45 days for processing. So it's 15 days in-house and 30 days back to the creditor. So 15 days for whatever credit reporting agency has it wrong. And then 30 days back with Verizon. Verizon has 30 days to say, oops, we made a mistake, or nope, they owe us money. They're going to source, verify, correct, and hopefully update. If Verizon comes back and says, no, they definitely owe us the money, and you're like, definitely we don't. You can add a statement of dispute if it's not resolved with the source, but that doesn't remove it from your credit report. But what it will do is, say you come in for a home loan, we pull your credit, we'll see that there is a dispute with that issue. We can read a little bit about it, and it's going to like offer us to have a conversation about it, right? It's going to open the doors to conversation. So what's not in your report? Criminal background, not in there. If you filed a bankruptcy, that's in there. If you got a speeding ticket, not in there. Medical information. If you owe the hospital money, that will be in there potentially if you're a delinquent on it, and it's over $500, but it's not that, you broke your arm. Buying habits and transaction data, not in there. So, like it will say, your Kohl's card, you are carrying a balance of $250. It's not going to say $250 on new Adidas track pants, right? Assets and bank account information, not on there. Banks are not allowed to share your checking account information with credit reporting agencies. The only thing that banks share is your mortgage information. So if you have a loan with a bank, they will share. Basically, you have signed off on that when you made your agreement. But on the actual banking side, your checking account, your savings account, things like that, we don't share that information with credit reporting agencies. You have a Visa symbol on your debit card so that you can use that wherever Visa is used, but that does not make it a Visa card. It is literally just a debit card. And so that does not get reported. So things like your utility bills and things like that might not necessarily be getting reported to a credit reporting agency, depending upon who you're using. So that might not appear on there, especially if you're paying with your debit card. Credit score, not on the report. There are 3 different companies. So the credit reporting agencies, the 3 main ones are Experian, TransUnion, and Equifax. The 2 major credit score companies are FICO and Vantage Score. All right, true or false? You must give permission for your credit report to be accessed. So the answer is false. You do not have to give permission for your credit report to be accessed. Basically, if you have put your full social security number on anything, just assume that they are going to be checking your credit score. The exception to that is employment. Your employer, if they're going to be checking your credit score, needs to tell you. So here are some myths. When paid, the bad debt will go away. It will be lowered for sure, right? It will say that it's paid, but it doesn't actually come off your credit report. So it will still appear there unless it's medical debt for the next 7 years. The credit reporting company denied me credit. We already talked about that. It was really your lender that denied you the credit. I'm not responsible for those charges on our account. Joint accounts. Joint accounts are a sticky wicket. Everybody on a joint account for a credit a loan, a credit card, a loan, things like that are both responsible parties for paying that credit. So, if it is not getting paid by the person that said that they were paying it, the other person is still responsible and it will affect their credit score. So if we had a joint account together and I went out and bought $250 worth of shoes and I did not pay for my $250 worth of shoes, you would be responsible for paying for my $250 worth of shoes, so that it doesn't affect your credit. That is a conversation that you need to have. It's why you should be really, really careful about who you are having joint accounts with, who has access to your card. A divorce decree separates joint accounts. It does not. The divorce decree says who is responsible for paying it, right? So, but the judge isn't calling your Visa company and saying, all right, Larry is responsible for paying this Visa bill. No, they're just giving you, your court documents. That's up to you after the divorce to take those court documents wherever they need to go and make sure that the lender knows that the other person is responsible for paying that. Those will help you maybe get your name removed from the account, but it does not resolve you in the credit company's eyes from paying that. Consumers must give their permission for a report to be issued. We just said that's not true. Requesting your own report and pre-approved offers harms your credit history. You may have seen ads for like Credit Karma, where one person's checking their credit on Credit Karma and the other one is yelling at them about that they're going for a loan. They don't want to harm their credit history by checking, and that Credit Karma will save you from that. It doesn't really matter, Credit Karma or literally anybody else. If you are checking your own credit, it does not harm your credit. There is only one credit score and it's on every report. You have 3 credit scores and likely not on any of your reports. Okay, taking care of your credit. So taking care of your credit is like owning a car. If you ignore it until it's broken, it's going to take a long time to fix it. So if you do your regular maintenance, it'll be ready when you need it. Meaning, when you start your credit, if you have a 10-year goal of buying a home, don't wait until year 8 to make sure that your credit is good to go. You should be maintaining your credit for that whole 10 years because you want to make sure that it is in really good condition when you go for that loan. Because things can happen, right? And when things happen, sometimes it takes a long time to fix it. So it's really important to be on top of it. True or false? The optimum number of credit cards for a strong credit history is 6. That's false. In case you haven't noticed, all of the answers are false. Credit to debt ratio is really what makes a strong credit history, right? So it's not the number of cards that you have, it's the balance on the cards that you do have in comparison to the limit on the cards that affects your score. So, you want to try and be below 30% as a ratio. That means if you have a credit card that is $1,000 extended to you, you want to try and stay below $300 worth of usage. Does that mean that you can't spend more than $300? No, that means that if you are over that you have to try and pay down quickly to get below the 30%, and then you can ease up maybe a little bit on paying that back or go just as hard if that works for you, but you definitely want to be below 30%. And that's across all of your credit. So if instead of having one credit card that's $1,000, You have 10 credit cards that are $1,000. Um, and so you have $10,000 worth of credit extended to you. Um, and you have 2 of those maxed out. So that's $2,000. You're still in the clear. You're at 20% credit usage. So it's looking at the entire amount of a credit extended to you versus the entire amount that you're using for your credit to debt ratio. All right. No credit, having no credit also means you don't have good credit. So because you haven't shown a history of being able to manage credit, so it would be like going to get your driver's license, but then never driving. Um, People don't know if you're a good driver if you don't ever drive. People don't know if you're a good manager of credit if you don't ever use it. So if you get a credit card and you don't use it and you just put it away and you're like, now I have credit, that's not true. You have to use the credit to be able to improve your credit score. All right, here's our dues of credit. Establish that credit report. We use credit for a lot of things, like I've said, insurance, um, employment, um, security clearance. So you want to establish your credit report and you want to make sure that your credit stays good. Always pay as you agreed. So if you're supposed to pay on the 5th of every month, pay on or before the 5th of every month. Get a credit card. So some people will say credit cards are terrible. Some people will say you don't need a credit card. Here's what I say. You do not want your first dip into credit to be a $20,000 vehicle when you could start out with a $200 or $500 credit card. If you make a mistake with a $200 or $500 credit card, it's a lot easier to pay off than if you make a mistake with a $20,000 vehicle. If you get a $20,000 vehicle and then you realize that you can't make the payments every month, that is a huge ding, and it's going to be a lot harder to recover from than if you owe somebody $250 and you can just pay them back. So while credit cards are oftentimes looked at as bad, they're actually not bad. If you get one and you use it and you pay it before the month is up, then you do not have to pay interest on that card, right? So if you use a card, you charge $100 on the card. When the bill comes in, you pay the $100. You don't pay any interest on that $100, right? A loan, you do, right? You start earning interest. You have to pay the interest like on the loan as soon as you get it. So just know that while credit cards do have a higher interest rate, if you use them appropriately, that shouldn't really matter. Time is key. So it takes a while to build your credit score. But building and keeping your credit score good from the beginning takes a lot less time than trying to repair your credit score if you've messed it up. You could mess up a credit score in like 2 to 3 months and then have it take years to fix. So just know that time is key. You just gotta keep on keeping on. You have to demonstrate stability, meaning that you're paying on time every month. You're not skipping a month here, paying on time for 3 months, skipping another month. That it doesn't work. Have a plan. So if you need to make a purchase, have a plan to pay that down. The point of credit is for it to be there in case of an emergency and to help us purchase things that we don't have the money to pay for. Like most people don't have $300,000 socked away to pay for a house. So we would need a home loan to do that. But you need to have a plan. How are we going to pay that off, right? What's our plan to pay that off? Home loan has that plan for you, right? Says you owe, $1,200 every month. A credit card doesn't do that, right? A credit card says, well, you could pay us, you spent $1,200, you could pay us $25 this month. for the rest of your life, right? So have a plan. How are you going to pay off what you have put on that card? Put your credit to work for you. Not all credit is the same. Um, it's not all equal, right? Some credit cards give airline miles, some give cashback rewards. If you have good credit, you shouldn't just be settling for whatever credit card you can. You should be making sure that however you use your credit is getting you rewards. And share your knowledge. There is a lot of uninformed knowledge about credit out there. A lot of things that people don't really understand about how the credit system works. So, helping people clarify that is also important. All right, true or false? Zero is a perfect credit score. It's false. It's false. Uh, the perfect credit score is 850. Um, your credit score is a 3-digit number generated by an algorithm designed to predict the likelihood that you will become seriously delinquent on your credit obligations. Perfect credit score is 850. So that is basically for consumer credit. If you go to buy a car, if you go into an auto dealership and you look and they pull your FICO score, you're going to see it goes up to like 900. It's because they use a little bit of a different algorithm for cars because they depreciate much more quickly. And so that is higher. But for the purposes here, if you're checking your credit score, if you have an 850 credit score, you have a 900 credit score when it comes to cars. Okay. So no need to worry. It's just a little bit of a different algorithm. All right. So what is our FICO score and how do they calculate it? So FICO is the Fair Isaac Corporation. They're the largest and best known of several companies for calculating your credit score. Most banks use FICO. Most credit card companies use Vantage Score, which we're going to look at a little bit of a comparison in just a second. And so this is how FICO calculates your credit score. This is their algorithm. 30% is amount owed. So that is your credit to debt ratio. How much credit is extended to you versus how much are you using? 35% is your payment history. Are you paying on time every month? So for new credit users, that 65%, that's all you've got. Because the stuff on the right, you probably don't have. 10% is credit mix. Credit cards are looked at differently than home loans or personal loans or other kinds of loans. They want to see a good mix. They don't want to see that you just have 50 credit cards. They want to see that maybe you have a couple of credit cards and a personal loan, or a couple of credit cards and an auto loan. That makes for a very good mix on your credit. The length of your credit history. So the length of your credit history is really important. If your credit history is a year old and you have good credit, or fair credit, that's a little bit different than if you have a 17-year credit history and you have good credit, right? Many people can keep it together for a year, but keeping it together for 17 years is a big difference, right? So the length of your credit history is important. They want to see at least 5 years on there before you really start getting too many percentage points for that. And new credit. They want to see kind of how often you're getting new cards, or have you not gotten any new cards in the last 17 years, right? They don't want to see that you're stagnant, but they also don't want to see that you are just getting new cards all of the time. All right, so here's FICO versus Vantage. So 40%, 35% for your payment history on FICO, 40% on Vantage. Amount owed, 30% on FICO. They call it credit usage on Vantage, 23%. Type of credit on FICO, 10%, that is that like, do I have a car loan? Do I have a credit card? Do I have a good mix going on? If you look over in the gray, theirs is different. They don't look at that. They're not really looking at that. So that's not a thing. Over here on FICO, length of credit history, 15%. They're looking at it over there in the gray, 21%. New credit accumulation, that's, are you stagnant or are you just getting new credit all the time? 10%. They're looking at 5%. And then they are looking at recent credit, all a total balance in yellow at 11. So their credit usage, they're also calculating your total balance, like overall, not just your credit to debt ratio, but what does your total balance look like? Is it high? Is it low? Because if I've been extended $1 million in credit and I am using $500,000, that's 50%. Even if I'm using, $300,000, that's 30%. Depending upon how much money I'm making, that could be really bad debt, right? And so they're looking at the total balance, not just your credit usage, your credit to like debt ratio. Okay. So what does it all mean? All right. If you're 800 to 850, you're an exceptional borrower. Nobody's questioning it. That your FICO score is in the top 20% of US consumers. Some of our lenders have never even seen anybody with an 850 credit score. It's very hard because of the algorithms to get an 850 credit score and be able to stay there. Things change all the time on your credit report, like swings are happening. It's really hard to be at 850. Nobody expects you to be at 850. If you're 800 to 850, you're like right in that sweet spot. Consider yourself an amazing, exceptional borrower. 740 to 799, you're very dependable. Like, it's the largest chunk of the community, right? 40% of US consumers are in that block of 740 to 799. 670 to 739, most lenders consider it a good score. It's the average score of the US consumer. Most first-time home buyers, because of programs and things like that, can get a home loan with a 620 credit score, 620 or 640, depending upon the bank that you're using. That's because some programs that are out there, and most first-time home buyers have a tendency to be younger people who may not have had, a lot of credit experience. 580 to 669, it's below average of the US consumers. That's where predatory lending comes in. You're going to want to be really careful about that. Really high interest rates. They'll often make you do auto pay for things, so it automatically comes out of your checking account, the payment on the same day every month, which for some people, especially people living to paycheck, is really difficult because oftentimes we're trying to figure out when can we pay things to make it work with when we get paid, not that it's going to come out on the same day every month, right? And 579 or less, it's in the lowest 20% of US consumers. Not great. Got a little bit of work to do there, right? All right, true or false. Paying a collection count will immediately improve your credit score. Immediately, no. So paying a collection account doesn't necessarily, unless it's medical, take it off your credit. But doing so will reduce the total amount of debt that you owe. So as a result, a paid collection account will be better in a lender's eyes than an unpaid account, right? They definitely want to see that you paid it. It will still be there. They'll still be able to see it. But it definitely looks better than something that's not paid. So don'ts of credit. Don't feel pressure to get a new card. Every single time I walk into TJ Maxx, they are asking me if I have a TJX rewards card. I do not have a TJX rewards card. I do not want a TJX rewards card. They're offering me 10% off my purchase today with an interest rate on the card of like 28%. That's not a deal, right? So unless I'm going to automatically pay that card as soon as I make the purchase, if I don't pay off that card as soon as it comes in, I've gotten 10% off to get charged 28%. Don't feel pressure. Don't pay late. Always pay on time as you have agreed. Late payments show up and stay on your credit report for 7 years. Don't let YOLO get in the way of your budget. Yes, technically you do only live once, but really you have to pay for whatever you do until you die. So the decisions that we make really affect us until we've died. So we don't want to be making decisions that will affect our goals and things that we have for ourselves because we're saying, Mel, you only live once. Don't just apply for any credit. Not all credit is equal. Some interest rates are higher. We want to get those cashback rewards or airline miles or whatever we're doing. Make sure you're really reading the fine print of credit cards. Don't carry a large balance that will affect your credit score. Try and get that paid down below the 30%. Don't close old accounts. Remember how I said the length of your credit history matters? Well, if you got a credit card when you were 18 years old, you didn't get another one until you were 28. And when you're 30, you close out the credit card that you got when you were 18, you have just lost 10 years of your credit history because that credit card is gone from your credit report. So don't close it out. If you're not going to use it, fine, don't use it. Or, put a tank of gas on it every once in a while. But don't close it out, especially if it is maintaining the length of your credit history. Don't just pay the minimum. You'll be paying the minimum for eternity if you do that. At least pay a little bit more than the minimum. Pay as much as you can every month on that card. Don't open multiple cards at once. When you do, it dings your credit report in that inquiries section, which will begin to affect your credit score, as well as you may be putting yourself at risk because credit cards evaluate how much credit's been extended to you versus how much you could manage. If you're applying for multiple cards at once, you might be putting yourself at risk because you would really normally not be extended that credit because they can't see that you have been extended it. Don't share your credit card information. I again am sure I'm preaching to the choir here. Some people do really some things that they regret later. Sharing your credit card information definitely will regret it later. Okay. Other helpful classes, budgeting 101, which happened last week, so you can go back and watch that. Credit repair, we will be doing a credit repair class. Welcome home, we will be providing a welcome home class. Oh, sorry. If you have any questions, like I lied and my contact information is not here. My contact information, let's see if I can just type it in here. Here we're gonna have some really bad handwriting. So Miria Gray, Chelsea Grattan Bank. Woo. I have mastered those sign here pads. Please reach out if you have any questions. I am happy to answer them. This is my cell phone number. I am an expert texter. So if you watch this and then you have some questions, shoot me a text and I am happy to answer them, or send me an email. Um, have a great day and hopefully we'll see you next week. Bye-bye.